How was yesterday? Did you learn at least one thing that helped save money, or great? Thanks. Yeah. So today we're going to be looking at advanced Western technical tools, and this is part of our trading triad. And it's interesting, I was at the fitness center this morning, and I was thinking about this. You know, to be healthy, you need three things. You know, you need strength training, we need stretching, and we need cardio, right? If you go to a gym and you start picking up weights without doing the stretching or a little cardio, what's going to happen? Probably pull you back, right? You'll damage yourself. So it's the same thing. We need three things to be physically fit. We need these three items: the candlestick charting techniques, Western charting techniques, and trade management to be fiscally fit. Okay. So yesterday we discussed advanced Western technicals. Today we're going to be looking at yesterday we discussed advanced candlesticks. Today we're going to be looking at advanced Western technicals, and then a little later on in the next section we'll be looking at trade management. And I think you understand from being here yesterday and all my other educational resources the power, the importance of combining candles with Western technicals. And this was an article from an interview a few years ago. A lot of magazines, a lot of websites want me to do articles for them, but I'm just so limited in time. So this was a cover story, and the magazine came up with the title. I didn't, all right? And it says, Helping East Meets West. And I'm glad they came up with that because it just echoed what I brought out during the interview. Yes, candles are a tool, but they're not a trading system. And we need to add and should add Western technicals to complement the candle charts. And actually, I'm glad they had this title because originally it said, this is what happens when first cousins intermarry. But I said, you can't have that. So why Western technicals? We agree, I think, the value added of candlesticks. But Western technicals, when we have a candle confirm a Western signal, we're increasing the percentages, probability of the trade working out, for using candles for a new trade. So in other words, we're going to look at this in a minute. We could use candlesticks to either exit a position or to enter a new trade. Okay, good question. I'm glad you remembered because I would have forgotten about raising your hands. This is the earliest I've ever gotten a question in a seminar, by the way.
Yeah, not to blow your whole day's speech, but did the Japanese traders use Eastern technicals?
You mean Western?
No, I mean,
okay.
For them, their own technicals.
Yes, the Japanese
for us would be Eastern.
Right. Okay, so the Japanese use Eastern technicals?
Well, did the Japanese use their own technicals
yes.
that would be different than ours, than the standard Western technicals, is what I'm asking.
Okay.
Japanese traders of old have technicals similar but different than current Western technicals.
Okay, so you're saying they're taking a current Western tool and put their own angle on it?
No, what I'm asking is, what did the Japanese do decades ago as far as technicals?
Other than candles.
Other than candles.
They've always done candles.
Okay.
Okay. The candles are older than our charts. In fact, let me see if I could draw this. Let me see if I could.
In a geography lesson.
First of all, before I draw something, the Japanese, in all the books I've had translated, and I've had probably about 15 books translated, and to give you a sense of how expensive it was, just a couple of paragraphs are like $66. In all the books I've had translated, I got them because they were books on candlesticks, but every one of them had books on Western technicals. At least a quarter, maybe half of the book is on Western technicals. So they would have, what the Japanese have been doing for generations is, a lot of the books I got go back, at least the more modern ones, 1960s all the way up to 1995 or something. They use Western technicals and candles. And up until recently, until my work, we've only been using Western technicals. So, at least for 40 years, I know the Japanese have been using both. But before the candlesticks, the Japanese had bar charts. Okay, again, this is from my research. Here, the Japanese had bar charts. And it's been so long since I made a bar chart up. This is the opening, or is it the other way around? This is the opening and this is the close? This is the opening and this is the close. Like you can see, I don't use bar charts. Okay, so this is the opening and this is the close. The next step wasn't the candlestick chart. They had something called the anchor chart. And the anchor chart was this. And this was pretty cool because this was the first type of chart that emphasized the difference between the opening and the closing. The anchor chart looked like an anchor. Whichever way the market closed was the triangle. Okay, so that was the close and that was the opening. Okay. This was, so up until recently we're using this. We didn't even go to the next evolution. The next evolution was this with the Japanese, and then the final evolution was the candlestick chart. So this anchor chart turned into a black real body. Okay, so that was the evolution. It actually begins before that. Before the bar chart, the Japanese used to use line charts, okay, before they had high-low prices. So, and there was some intermediate stuff, but that's kind of the evolution of candlestick charts. I don't know how long, essentially, the Japanese have been using Western technicals. So as I started to say, that there are times to use candles for a new trade and there are times to use candles to exit a position. And the aspect of candles and Western technicals will let us decide which of those two scenarios we choose. And it'll become clearer as we continue this session. And as we know, from prior information, candles don't give price targets. Candles are great for calling potential reversals, but the only way we can get price targets is using Western technicals. And it could be something as simple as looking at a prior high or resistance area, support area. So let's focus on times to take a trade with a candle signal. In other words, take a trade either to exit a trade or to get into a new trade. And this is where Western technicals come in. So one of my trading principles, and we've discussed this previously, candlesticks are a tool, they're not a system. If you have a candlestick signal by itself, it's normally not a reason to do a trade. And with this in mind, that if we have a candlestick signal not confirming a Western signal, and I'll show you some of my Western signals. We'll go over my favorite Western tool today. You may have your own favorite. Stay with it. Okay, but essentially the idea, the thrust is that if there's a candlestick signal in and of itself not confirming a Western signal, I would use that to offset a current trade. It doesn't matter how you did the trade. You may put it on, with a candle signal or something else. But if there's a candle signal that doesn't confirm something else, I would use that to offset a trade. If we have a candlestick signal confirming a Western signal, that's when we should think about initiating a new trade. Once again, when we're using candles, we've been focusing on reversal signals, the candles. So we're trying to pick tops and bottoms. Okay, that's a high-risk trade. You have high risk, you want the odds on your side to increase the probability of that high-risk trade working out. What will do that to enhance the probability? If we have a confluence of technical signals. So, as a general rule, we could think about initiating a new candle signal if it confirms a Western signal. Also another option is because, we talked about price confirmation, a new subject, we talked about in the prior session. You may want to have, say there's a candlestick, and it depends on your risk orientation. If you have a candlestick signal not confirming a Western signal, and you get price confirmation of that candlestick signal, you may want to do the trade. Okay, so that's a little riskier. The highest probability trades, again, based on my experience, is if a candle signal confirms a Western signal, and then if you get price confirmation. The next best, if you have a candle signal and then price confirmation. And the least good is if you have a candle signal by itself. So when I say least good, meaning that I would only use a candle signal by itself to just exit a current trade. Any questions on that? It makes sense? Okay. So with this in mind, okay, on the left side of the chart here, we have a series of small real bodies. And this is a really nice example of the power of the candles. Although the market's ascending in the red circle, what are two things that would get us nervous about this little action here, the price action? What are two things? Small real bodies, and anybody see a candlestick signal?
Yes.
Okay. Little black, real body, not a strict criteria engulfing pattern, but a bearish engulfing pattern. And this is just a nice reminder of the power of candles compared to a bar chart. Okay, because if this was a bar chart in that red circled area, the market would look fairly healthy, right? It's moving higher, higher highs, mainly, not all higher closes, but higher lows. But remember, we're using the real bodies to gauge the momentum of the move. We have a bearish candlestick signal. That's a cautionary signal. Now, if I saw that by itself, just as is on the left side of the screen, I would use that to exit a long position. But I went back a little further in price, and that red circled area is shown by that blue arrow. Resistance. So there, especially with a bearish engulfing pattern, we could think about selling short. Okay, so this is a nice example. If we had the situation on the left with the bearish engulfing pattern and the small real bodies, obviously we know this is not a bullish engulfing pattern, right? This and this, right? Because the trend is wrong, right? Let those who don't have the, have the education that you're paying the time and expense for to learn, let them buy on that, right? It's more money in your pocket, right? So it reminds me of the story, two traders are talking to, John and Jack are trading to each other, and John says to Jack, he says, there's money in the market, and Jack says, yeah, mine. Let it be theirs, right? So if I just saw this on the left, I would use this to lighten up on a long position. I would not recommend selling short. But when we add it to confirming something as basic as a resistance area, then we could think about initiating a short position. And obviously, this is true in the downside. If you have a hammer, but it's not confirming something else, I'd use that to cover some shorts. But if the hammer is confirming a support area, I would look at that to initiate new long positions. Okay, so here we have crude oil. This was going back a couple of years, a little while ago. Bullish engulfing pattern, just reviewing, because I've done prior resources on candles and Western technicals. Just want to quickly review that. So here we have candles. I like Bollinger Bands because the Bollinger Bands are a good way to show us if the market's overbought or oversold. So now we have a bullish engulfing pattern, correct? Shown by the green semicircle at the low end of the bullish engulfing pattern. And for you, how many trade futures here? I know there's some futures traders. Okay. Since, for the futures, you look at open interest. So here we have declining open interest, which means that the longs are liquidating. It's not new shorts, which is a positive signal. So we have, and that's the purple line. So we have a group of signals here, the bullish engulfing pattern, and then Western signals, Bollinger Bands and open interest. So this greatly increases the likelihood of the market reversing. Now, I know many of you probably use MACD. I call it the Scottish oscillator, the MACD. Okay, so here, and I'm not an expert on MACD, so here we have a crossover, okay, on the MACD. So it moved under the signal line. So it's a potential turning signal. And we had a bearish engulfing pattern actually a couple of days before that. You're going to find, for those who use oscillators, a lot of times the candles will give you reversal signals ahead of the oscillators, and then you can use the oscillator to confirm it. Okay, same thing here, a crossover in the green arrow on your right. And a little before that, we had a bullish, or about the same time, a bullish engulfing pattern. Now, if you have a Western signal that you find works extremely well, and you're getting a group of candlestick signals that are giving you indications kind of counter to that Western signal, let the Western signal be confirmed before taking the trade. Let me show you a case in point. By the way, this became a resistance area with a shooting star. Okay, here we have our series of potential bottom reversal signals at the red arrows. And on this moving average, and I forget which one I was using, this was a few years ago, this moving average is acting as really good resistance. So although we were getting white candles, we had a piercing pattern, a hammer. The fourth red arrow is not a piercing pattern, but nonetheless, we had a series of black real bodies. And each session after the black real body, the market bounced back. So it looked like the bears were unable to hold the lows. The bulls were able to gather enough strength to kind of counterattack, but look what was acting as resistance. So until the market broke above that resistance area, yes, we were getting tentative signs, and this was actually one of the markets I was looking at for one of our institutional clients. And what I do with our institutional accounts, they tell me the Western tools they use. Okay, so that's why I don't remember. This might have been a 9-period exponential. Don't quote me on that, but I remember they liked using exponential moving averages. So whatever Western indicator they liked, because they were experts in their market, I would throw on and then add the candles to the analysis. So I would throw this on the chart, and I was suggesting to them we were having bottoming signals, but your moving average was still acting as resistance. Let the market close it above it. And it didn't do that. So the idea of this chart is whatever your favorite tool is, say you have a Fibonacci or something like that, a retracement, and maybe it's a resistance area. You're getting bullish candlestick signals at the resistance area, but let it get through that retracement then if you find retracements work real well.
Using that as breaking the...
It didn't close. Okay, let me repeat the question. Okay, she was saying that this bearish engulfing pattern, and we'll get to that in a minute, crossed above the moving average. Okay, why is that not a bearish engulfing pattern? It's a downturn. A bearish engulfing has to, right, okay. But I think the thrust of the question was, didn't it get above the moving average? And it didn't close above the moving average. General rule, when I talk about breaking support or resistance, assume I mean on a close. Okay. That's a good question. So, okay, volume. Okay, next to price action, to me, volume is the best indicator because it shows, kind of like the candles, the force behind the move. Unfortunately, on the Forex side, we miss the added value of volume. So this is the crack and snap, and actually this should have been, this line is a little off here. Okay, the line should be the lows here. Okay, that red line. So what happened was the market broke under the support area and then snapped back. And as a little refinement to the crack and snap, we would like to see, if you want to be bullish, we want to see a breaking of the support on light volume and then the market getting back above the broken support area on heavy volume. And as mentioned previously in the prior sessions, say we have a bullish engulfing pattern. And this is just kind of makes sense. Okay, we want heavy volume on a white candle and small volume on the black real body. So whatever the patterns are, we could always very easily and very significantly add volume to it, assuming it's non-Forex. Okay, Paul's going to be right there.
Can you just repeat that one more time? The volume?
The volume, okay, on the crack and snap. All right, so for those not familiar with the crack and snap, let me go over what it is again, because it is one of my prior resources. We have a support area tested more than once, so it has to be tested at least a couple of times. The market breaks the support either on the same day or actually closes under the support level, and then either the same day or within 2 or 3 days gets back above the broken support. Okay, so the market cracks support and then snaps back, and I really like that. In fact, one of the charts we talked about yesterday with Bear Stearns, remember we had the bullish engulfing pattern as support, and the market held support. The Bear Stearns news took it under the support level. By the end of the session, the market closed back above the support. That was a crack and snap. And what's nice about it, again, I don't want to spend much time on it because this is my other resources. What's nice about the crack and snap is your target is the most recent high. Okay, and you don't have to worry about taking notes in it because it is in my, you can watch my prior DVDs. So in other words, as soon as we have the crack and snap, and we'll get to your question in a minute, as soon as we have the crack and snap in the S&P, my target was the top end of the range of 1,400, which the market got to. And we knew that, hundreds of points before that. So, and with the crack and snap, your stop out level is the low of whatever the low of the move is. So you have a stop, you have a target, and just adding a little bit more thrust to this is that we could add volume to it. So I'd be more confident of this working if the volume is light on the break, and then the bulls come back on heavy volume. Okay. A couple of questions over here. Okay.
Would you say that's bull sash?
That's also a bull sash, yes.
Now, in your work, do you think a bull sash is as strong as a bullish engulfing pattern or a
A piercing
piercing
pattern.
hammer?
Okay, as a general rule, if all else is equal, which is going to be very unusual, but let me explain. The more that white candle, think about a lot of things with the candles are kind of, if you think about what's going on in the pattern, you can figure out which is stronger potentially. And when I say stronger, remember, candles don't give price targets. So when I say stronger, means in a 1-point support area, more likely reversal. With the bullish engulfing pattern, we do have the white candle wrapping around the black, right? Which is positive. With the bull sash, the market actually opened above the prior close and then continued higher. Okay? With the bull separating line, remember, we have the black candle, then the white candle, the market gapped up here and went there. So remember the candle progression we did? That's the strength of the more bullish or more likely reversal candle signals. So to me, a bull sash is a more likely reversal than a bullish engulfing pattern. However, like the bull separating line, sometimes by the time you get the signal, it's a bad risk reward. This would have worked out fine because this was a nice target, you know, about $3 higher. So that's one of the reasons I made the candle progression. That's the likelihood of the market turning, the probability, the strength of the candlestick signal. So the least would be bullish counterattack, then piercing pattern, then bullish engulfing pattern, then bull sash, and then bull separating lines. That's the strongest, right? But unfortunately, it's the strongest. A lot of times it's going to give you the worst risk reward. However, there's always a however, right? If I saw a bullish engulfing pattern confirming a support area, as opposed to, and forgetting about the risk reward, a bull separating line not confirming support, where would I put the trade? Altogether, the bullish engulfing pattern, right. So if all else is equal, I would use that candle progression, but always have to look at candles in context. That's why it's dangerous to trade with the candles on themselves. And there's a common question I'm asked, which are the more powerful candle signals? And the way I have it in the candle progression is the way I would view them, but it's rare to have a candle in isolation. You should not use candle in isolation. But all else equal, I would use the candle progression. Okay.
What's the difference between this and upthrust?
It's the same thing. Okay, yeah. In my older resources, I would call this this was actually called a spring in my older resources. This was Richard Wyckoff in the 1920s. That was the term to use. He had a very successful newsletter. I think he had a couple 100,000 subscribers. This was in the 1920s before the crash. And he made a lot of money. He was a very, very good trader. And so he referred to as a spring. The market would spring back. And an upthrust is the opposite, where the market had resistance, it got above resistance, and then pulled back. I call that now falling off the roof. I call this a crack and snap, but it's the same idea. Okay. Any other questions before we move on? Okay, now we're going to be looking at the ADX. Okay, this is the indicator. In our marketing material, we said, what's Steve's favorite Western tool? This is it. Okay, and this was one of the questions we had before we did a seminar, similar to this, of all the technical indicators, beside candles, I'm assuming he means, what should I be concentrating on? And again, you're going to have your favorite Western indicators, so stay with them. But I'll show you why I like the ADX so much, and I think you'll agree it makes sense. And I think it's just a perfect fit with reversal candles. So we'll go through the ADX. Okay, so the ADX stands for the average directional indicator. It shows how strongly the market is trending. It doesn't show the trend of the market. i.e., on the left side here, we have a little bit of an uptrend. The ADX is also ascending. Okay, that means the uptrend is brisk. On the right side of the slide, notice how the ADX is also ascending during a downtrend. So ADX, the only thing it does is measure the intensity of the trend. It does not give us the direction of the trend. So a stronger ADX means the more directional, the higher the intensity of the trend. And just to emphasize that, okay, here we have the ADX on the blue arrows at 1 and 2, okay, which way is the market trending? You don't know. Go ahead. You said that. You don't know. All you know is that in areas 1, the trend is strong. In area 2, the trend is weak. Okay? So in area 1, it's a strong uptrend. In area 2, the uptrend is running out of steam. So, any questions on that? Because, yes, okay.
Is it the absolute value of the ADX that makes a difference, or the trend of the ADX?
Okay, we're going to go over how to use the ADX in a couple of minutes. Okay, so I'm going to give the definition first. Okay, let me show you how to use ADX, and then we're going to show how to measure the intensity of the trend, because I think most of you using ADX are not using it correctly. Okay. Some indicators, moving averages, momentum trading, work better in strongly trending markets. Okay, I don't know how many of you are aware of that, but there are some technical indicators, Western indicators, that you should be using pretty much only in trending markets. There are other indicators that you should use in non-trending markets. So the second bullet point, oscillators and others work better in non-trending markets. So a way a lot of traders will use the ADX is, let's say they're using a moving average crossover, and they want to buy during a moving average crossover. We'll look at more moving average crossovers in another segment when we talk about trailing stops. I have some cool things to show you on that. But moving average crossover, so say you have the shorter-term moving average crossing above the longer-term moving average as a potential buy signal. When using moving average, it works, it really should only be used in trending markets. So what some sophisticated traders will do is they'll look at the moving average, but they'll also make sure that there's a trend intact. If you're using oscillators, MACD, RSI, it doesn't matter what oscillator you're looking at, you should have a weak or no trend at all. Oscillators work much better in box ranges. For those who have experience in oscillators, and when you were first learning about it, you'll probably remember the time when you had overbought oscillator reading, the market was moving up strongly, and the RSI or stochastics or whatever you used was moving up strongly. You know, it got above 70, 80%, which is supposedly overbought, but the market kept on going higher. The oscillator kept on going higher because oscillators really don't work in trending markets. Okay? For those who know oscillators, agree with me on that? Right. Because I'm sure some of us have gotten burnt with that. So that's one of the ways to use oscillators, you know, to see if the market is trending or not, to make sure that the technical tool they're using is working in the right environment, a la the ADX. Okay, let me give you some cautions on the ADX. Okay, they only work on daily charts. And now, most of the information I got, almost all the information on the ADX, I'm going to give you my source in a couple of minutes. You don't have to write it down. I'll give you his, I'll give you his contact information. It's Chuck LeBeau. He's like the expert on ADX. But essentially, ADX is based on the directional movement indicator, and the directional movement indicator compares highs to the prior high and lows to the prior low. And if it's inside day, the zero directional indicator. If it's a higher high, they take the difference. That's a DMI plus. If it's a lower low, they take the difference, DMI minus, and other things are involved like true ranges. But essentially, if you have an intraday chart and you have a gap, like you're looking at a 5, a 15, or 30-minute chart, and you have a gap, it really skews the ADX readings. It just blows them up. However, a thought I had, and Chuck agrees with me on this, a plus on the FX side is you guys don't have gaps intraday. But that's why I'm saying except for FX. Okay? So non-FX can't use the ADX, but there's a possibility because of the lack of gaps in the Forex, you can use it intraday. Once again, I haven't looked at it deeply. It's going to be on my to-do list, my big to-do list. All right, so we only use ADX for essentially entries. It's a lagging indicator, and it's especially slow to recognize a new trend. Let me show you a case in point here. Okay, this is the ADX on the bottom, and we'll look at the number I'm using later on. It's actually a 14-period ADX. Now, because of the mathematics behind the ADX, a 14-period ADX is not 14 days. It's a double smoothing. It essentially, Chuck told me the ADX is so powerful, and this should be true with any system that works well. ADX really works well anywhere from 7 to 30 periods, and he's tested them all. His favorite 2 periods, and I'll mention, his favorite 2 periods are the 14, which is what Wells Wilder did. He's the one who revealed this in the 1970s, and 18 period. But he said it doesn't matter pretty much what you use. It all works well. So I focused on the 14, the 18, they both work equally well. I've tried them. So he said with the 14 or the 18 period ADX, that takes about 30 to 40 days worth of data. Okay, so when you hear a 14 period ADX, don't think it's 14 days. And the reason that's important to keep in mind is, and this is a comment we got from a prior seminar where I revealed the ADX and candles, and Pete mentioned to me, gone from 120 to 150, and the ADX on a daily basis has not moved up. This is surprising comments. And this is a negative to the ADX because it's a lagging indicator. What's happening is, although the ADX is moving up here, the market's moving up here, the ADX is still taking into account this information. All right? It's like a regular moving average. As you progress, you take off data, but you still have the old data. So it's slow to react to new trends, but we're not going to be using it to try to get in on the new trend. Looking at the ADX as far as waiting for it to increase and then buying. So just keep that in mind. That's a little bit of a negative. Okay, but let's show the aspect. Any questions on just an overview of the ADX? Okay, Paul will be right there. And then we're going to show how to define a strong ADX, how to define a weak ADX, and then how to use it with candle reversals.
So in this case, how you would use the ADX?
Okay, we're going to look at how to use it now. Okay.
And you prefer this visual over the crossing of the negative DMI and the positive DMI?
Yeah, okay, the DMI plus and DMI minus. Once again, I could spend a full day on this, and actually it's going to be, I'm going to have a lot more material in my coaching session. I'll be talking about DMI. I'll be using ADX. I'll go over some of the things I'll be doing in coaching. But the DMI plus and DMI minus, actually the relationship of the two is actually the ADX. So I'll show you why I like using the ADX rather than DMI in a minute or two. Can you repeat this last thing you said? Yes. The gentleman had asked about DMI. DMI stands for Directional Movement Indicator. And there's DMI plus and DMI minus. And you could use DMI, once again, it's beyond the scope of what I was planning on talking about today. I'm getting to that more in coaching. The DMI is a way to show the trend of the market. If DMI plus is above the DMI minus, the trend is up and vice versa. And it's the relationship of DMI plus and DMI minus that actually creates the ADX. All right? So I'm going to show you why I like using the ADX rather than the DMI. There's a question over here. Then I think, okay.
It seems very confusing that we're only going to use it for entries, and yet it's a lagging indicator.
Yeah, and I'll show you why. Okay. Okay.
You're still looking at volume.
And it's mainly a lagging indicator for showing new trends, not showing us the diminution of an old trend. And that's the key difference, and I'm going to show you why that's important.
Steve, we're still using volume, though, as what helping us. This is just part of it.
Oh, yeah, I would use volume. Yes, that's
Yeah.
a great point. I would use volume. Think of this as one of the tools. I really like this. But this is one of the tools, definitely. Volume, so. And it'll become clearer when, although this is a negative about recognizing a new trend, ADX is actually good at showing us when a trend is slowing up, and that's what we're going to use it for. Was there a question over here, or we're okay? All right, so let's move on. Common mistake. How many look at ADX levels? Okay. The correct way to use it is looking at the slope of the ADX. Say we have an ADX level of 20 and an ADX level of 40. If you were just looking at the ADX levels, which would be a stronger trend? 40. What happens if the ADX was coming down from 40 to 220? Okay, or let's do it the other way around. What if the ADX was going up from 20 to 40 and you had a strong slope? That to me is more important than a higher level. Okay? And this is based on research Chuck has done. Okay? The slope is the key, it's not the level. And the advantage of the slope is that it gives the predictive power of a change in trend. Okay? Okay, we're going to look at how to use that in a minute. So an ADX of 20 that's rising steeply is much more predictive of a trend on ADX than 40 that's flat. Make sense? So the slope, and this is just common math, is the change in ADX from yesterday to today. We're using a daily chart. Okay, so today's ADX level minus yesterday's ADX level. And generally, well, I mean, not generally, the greater the slope, the stronger the trend. Okay, here we have an ADX level, and you need it to 2 decimal places. Some charting packages only have 1. You need it to 2 decimal places. If your charting package does not have 2 decimal places, change charting packages or tell them to get to 2 decimal places. And I'll show you why. All right, so the ADX here is 20.64. Okay, how do we know what the slope is on that day? How do we figure out what the slope is? What's the slope on that day? If anybody could give me an answer, I'd be amazed, because there's no way you can give me an answer. You have to know what the ADX was yesterday, right? Everybody agree? Can't tell the slope without 2 numbers. So what we do is the ADX yesterday was 2096. So what's the slope? Down. How much? 0.32. Okay, so that's how we determine the slope. Any questions on that? Because it's going to be the key to, okay.
Steve, how do you find what the ADX for that day is? Because I don't see it listed.
Oh, that's where, remember I showed you the crosshairs? Whatever charting package you have, you should be able to scroll over. You'll put ADX on your chart, you scroll over it, the date, and it should have the ADX.
Okay, thank you.
Okay. Or you can call Paul whenever you need the ADX. Doesn't matter what time of day or night, any market, anytime. Yeah. Was there another question? Okay, over here. What's the ideal slope range? Okay, the question, not the bother. The question is the ideal slope range. We're going to get to that. Okay, so we're kind of going step by step. You know, it's one of the things I get good feedback on the seminar. I do things logically. I spend a lot of time on that. So I'm glad you're asking the questions, because you know this is the next step. So that means that's in your mind, but it's going to be the next step. So I'm doing this correctly. That's nice. So, all right. So here, all right. So the slope is, if I did the math right, minus 0.32. Okay, here we have an ADX 22.04 and 24.11, and we don't have to do the math, but is it a minus or a positive slope here? Positive, right. So the slope is, again, I hope I did the math right, 2.07. Okay, so now we understand how to get the slope. Let's take the next step on how to use the slope. Okay. What is a strong trend? With an ADX 14 period, or you can use an 18 period. Yeah. 14 period ADX slope is increasing by 0.5 or more. So here we have a couple of ADX values. The slope is 2.08. We took the ADX from today. Okay, sorry. So here, the ADX between this one and that one, okay, is the slope on the ADX is 2.08. So that's a strong trend. Okay, here we have the slope of ADX, I'm sorry, the ADX level is 2603 and 2756. Okay, what's the slope? We take today from yesterday. So what is that, 1 point plus or minus? Plus, right, okay. Okay, so that's telling us there's a fairly brisk uptrend. What's a weak trend? A weak trend is an ADX period slope of 0.25 or less. And the reason it's not 0.5 or less is because between 0.25 and 0.5 is kind of nowhere land. no man's land, however you want to express it. However, if you want to be strict and you want a higher probability, if you're less risk-oriented, the slope should actually be flat or decreasing. Okay? Up 0.25 is showing us the market is losing a trend. When it's actually flat or decreasing, it's turning trendless. Okay? And we're going to see how to use this in a minute. So a weak trend, strict, should be a flat ADX or minus ADX slope. A strong trend is an ADX slope of, so to be strict, it's a flat, or if you're a little bit more risk-oriented, you could use 0.25 or obviously or less. And this is defining a weak trend. We're focusing on weak ADX in this part of the seminar today. And this is a book I recommend. Chuck used to work at E.F. Hutton also. I used to work at Hutton different time periods. And this book actually goes back to 1989, but is a great book. Don't let futures markets dissuade you. This is mathematically oriented, okay? So if you like that, this is the book. And this is Chuck's email. Oh, it actually should be chuck@smartstops.net. Okay, .net, yeah, .net. So just to let you know. But Chuck's been great. We've been emailing back and forth in conversations because he's like I am to candles, he's to ADX. So let's look on ADX. And this is why it's one of those things I thought of a while ago, and why didn't I think of this years ago? Candle signals are reversal signals, right? Why not increase the probability of the trade working out by putting a candle signal on when the trend is weakening? Makes sense, right? Yes. Like, duh, And, I had this cartoon made up. Going against a very strong trend can cost you money. And that's what sparked my interest in the ADX. I don't remember when it was, 9 months ago, 12 months ago. I just thought of that. And I've always liked the ADX. It's kind of in the background, but I've been doing so many projects. And it's just such a great fit. So, as far as candle reversal signals are concerned, it's better to use, and it was correctly pointed out, this is just one of the tools, the ADX. Better to use candle reversal signals for a new trade when the trend is weakening. What's a weak trend? Strict criteria, what's a weak trend with the slope? Flat. If you're a little bit more aggressive, 0.25. And again, I would always think about confirming a Western signal, but this is just one of the tools. Yes?
It's not a flat either or.
Right, okay, the question is not a negative 0.25. For those a little bit more risk-oriented, want to try to, even though the slope is not negative, it's plus 0.25 or less. It could be plus 0.10, obviously at 0 or minus is less than 0.25, but it's plus 0.25 or less. But Chuck really says a trendless market really should have a flat slope on the ADX. But 0.25 is when the trend is beginning to really weaken. Okay, any questions so far? Okay, Paul's going to come in.
I'm not clear about what is the strict criteria. Minimum, I understand it should be 0.25 or less, but the strict says period ADX slope decreasing.
Right. Okay, so to say the market is starting to turn trendless, the ADX slope should be flat or declining. All right, if the ADX is up by 0.25 or less, it's really not a trendless market, but it's starting to lose its trend. So ideally, if you want to say the market is not trending anymore, you would wait for flat slope or negative slope. If you want to say the trend is weakening, but it's still trending, but it's weakening, it's 0.25. So if you have potentially a high setup probability to trade and everything else is in your favor, and the ADX is up 0.25 rather than flat, you may decide to do the trade anyway. And there are going to be times, I'm going to show you an example, where you have a high ADX, and you may do the trade also.
So in terms of numbers, is there a number that it should be less than? Like if minimum is 0.25, for being a flat, should it be less than a particular 0.0 or something, or
Yeah, when we say
negative?
flat, we mean 0 or negative.
Negative, zero,
Right.
negative.
0 or negative. That's what I mean by flat or negative. The ideal would be if everything lines up. It's going to be rare. You have a candle signal confirming a Western signal with ADX, we'll look at more ADX in candles, and the sector is moving up, and you got a bullish candlestick signal, and you have a good ADX and all that. It's going to be rare when everything lines up, but that we're going to look at bringing the tools together. Okay, so here we have a potentially weakening trend. The ADX is down 0.31. Let's look at reversal candles and ADX. Once again, I would prefer the strict criteria, but okay. Sometimes you don't have to measure the slope. Okay, you see where it says, do we have to measure the slope on the ADX on this hammer? Why not? Well, what? Why? Well, why don't we have to measure the slope? It's not so much as a lagging indicator. How do we know if the slope is weakening or strengthening? Don't we have to subtract today's from yesterday's? You can see it. The slope is moving down. You don't have to bother doing the numbers. If the slope was 0, it would be flat. A negative slope means it's decreasing. So you don't have to, if you see something like this, a downward slope, you know that the ADX is decreasing. Where you're going to have to start looking at the ADX numbers is, over here, over here. But if it's decreasing, you don't have to worry about the numbers. You know the slope is negative. But when you're new to this, you're probably going to want to look at the numbers just to confirm until you get comfortable. Let's look at how to use this. Candles are reversal signals. We want to, or we should think as one of the tools, think about initiating a new candle signal, reversal signal, when the slope is weakening. How do we define a weak slope? Flat, right? Or if you're a little bit more aggressive, all right. So, we have, what is the blue arrow here? A hammer. Do we have a strong trend to worry about? Nope. The ADX level is a negative slope, so it's telling us that the trend is running out of steam. And what that means is that it's more likely a reversal signal because you're not going against a strong trend. Same thing here. Okay? And this doesn't always work. That's what this is about. We have a bearish engulfing pattern. The ADX, and the slope here, I didn't bother putting the ADX levels. The slope here is 0.40, so the trend is weakening. So we would think as one of the tools that might be a good trade. It didn't work out. Once again, I'm not looking at confirming Western indicators. We're looking just at ADX and candles by themselves, or suggest looking at if it confirms a Western signal, and we'll look at this later on about trade management, good risk reward, but we're just looking at candles and ADX as a separate entity. Here we have a doji, long upper shadow. The next section is actually a bearish engulfing pattern. The ADX level is down 0.10. That's telling me there's a weak trend. We have a doji. Think about maybe selling it. Okay. Now, assuming, especially if the doji confirms resistance, if you wanted bearish confirmation, did you get it the next session? Either with a bearish engulfing pattern or you had that black candle confirming the doji, either way. So this is how you use the ADX. I'm going to look lots of examples here. Bullish shadows. Okay, some of these are probably hammers. In the blue box on the left, it's hard to see the color here, but on the left, that is a strong downtrend. So essentially, if you're buying there, you're going against a strong wind. It's like pushing, like the cartoon, you're pushing against the wind, all right? ADX, a really strong trend is 1.0 or higher. So this is a really strong trend. And ADX, as I mentioned before, a downside with ADX is that it's slow to recognize a new trend. But when you're using slope, it is good for picking up slowing of current trends. And that's what we're using the ADX for in the candles. So here we have a series of bullish shadows, hammers, but you're going against the momentum, the strong, and you could think of it as synonymous, the momentum, strong downside momentum of the market. So the probability of the hammers working or long lower shadows working is lower. Maybe if you're potentially bullish and you see these high ADX levels, you at least want price confirmation or something else. Whereas here we have a series of lower shadows on your right, and there we could think the probability of the market turning is higher. And once again, why didn't I put ADX numbers on, or ADX slope on the chart here for the rectangle on the right? It's down. The slope of the ADX is down, so that's showing us the trend is now weaker. The strong downtrend is now weakening. So now you're buying or potentially buying when the downtrend is losing force, so there's less wind against you, there's a less obstacle. Does it make sense? Yeah. Okay, so here we have, what are the patterns at the arrows? There's two patterns at the green dashed arrows. Two signals. Bullish engulfing pattern, and what was the first session of the bullish engulfing pattern? Hammer, all right? Let's look at the ADX levels. And it's upward sloping, so we need to do the levels here. Okay, the first one is an ADX of 27.98, and the second session, remember you need two sessions. So although we're looking at the hammer here, to see the ADX, you need more than the hammer, you need the prior session. So the ADX level was up, what, 0.4 here? Okay, and as I mentioned before, that's kind of nowhere man land or no man land. You need at least 0.25 or better than that flat. On the white candle of the bullish engulfing pattern, what was the slope of the ADX? Rounded off. Yeah, about 1.5. Is that a strong trend or a weak trend? Strong trend. So now if you're buying here, realize, again, you might want to buy here, but realize you're going against a really strong trend. If you have a Western signal, maybe you'll still do the trade if you want to wait for price confirmation, but you definitely should wait for something else because the trend is so entrenched. So here's another example. With a negative ADX. And what else is also good about thinking about selling this from the short side? A resistance area. Exactly. Okay, that's what pattern is that? Okay, let me highlight it because oops. What pattern is this? Dark cloud cover. But I'd be nervous about this because the ADX level is very high. It's almost actually 1.0. But just because you have a high ADX doesn't mean the market's not going to reverse. Okay? So the higher probability trade to me would be the one where the ADX is negative. Did I do this right? Negative 0.31, especially since it's confirming resistance. Okay, does a strong trend mean no trade? Strong ADX, but does it mean we don't do the trade? No, it doesn't. You can have a strong ADX, but if you have a lot of other things lined up, because this is just one of the tools, you may say, okay, the ADX is very strong, but it's confirming a support level, right? Good risk-reward trade. Everybody see that? The risk. Now, is the risk to the low of the hammer, or would the risk be somewhere else? Right, the first green line. And my target would be the high of the bearish engulfing pattern. So realize that the ADX is just one of the tools. Maybe what you would do is go in a little lighter because it's a strong downtrend. Add to position as the market's moving up. But the thrust of this is that the ADX, even if you have a strong ADX, doesn't mean you don't do a trade. If a lot of other things are lining up, this is just one of the tools you have to take into account. Okay, any questions? So let me go through the rules. Oh, there was a question? Okay.
I had a question. In a case like that, would you expect that in the next couple of bars that you would have a weak trend or not?
Okay, the question is, would we expect in the next couple of bars that we would have a weak trend? I would think that because the market, remember, it's a lagging indicator, and looking at the action over the last few weeks, it looks like we've been kind of in a horizontal band. I would think that we could expect the ADX to decrease, but I don't think you can predict what the ADX is going to be tomorrow. Okay? Because in order to get the ADX tomorrow, although we do take off old data, we add the most current data. It's like a moving average. You have a 5-day moving average. You take the 5th day off, and you add the newest one on. Any other questions?
Yeah, Steve, in your research, did you choose the ADX like as opposed to like a 5-8 moving average cross? You find that works quicker?
That's a quick answer to that, and I could spend a lot of time because this is one of the reasons Chuck looked at the ADX. I'm going to show you my favorite based on Chuck's work. He tested a million moving averages, and he found 2 moving averages that worked really well, whether it's futures and stocks, and I'll go over that a little bit. But he found the moving average crossover worked really well. The problem was it worked really well only if the market was trending. That's when he started to use the ADX. The downside, again, I'm going to have whole sections on coaching on stuff like this, but just a short answer. The downside is because the moving averages were earlier indicators, he would get a crossover in the moving average. The ADX was still moving down. By the time the ADX moved up, a lot of the moving average crossover move had already occurred. That's when he started to use slopes. He used to use the absolute value. That's when he started to use slopes. So because of his moving average crossover buys and sells, that's when he started to use the ADX. It's interesting you brought up that question because it's exactly what got him into it. So.
The question here is on earlier you said on intraday charts, gaps affect the ADX. If you look at this chart here, you have gaps in there. Does it affect it, or the calculation is just do it?
I think, again, I'm not the expert on intraday, but the way Chuck explained it to me is that relative to the size of the bar, if you have a gap, so if you have a 5-minute candle or 10-minute, let's say it's $2, and you have let's actually make it like a 50-cent candle line, and then you have a gap $1 higher, it's just much larger in relation to the size of the high-low range, all right? Something like this, I'm wondering, because I see some gaps here, they are pretty big, but as related to the body, related to the high-lows, I don't think they're that extreme. So let's go through the basic rules for bear candle reversal signals. We get the candle signal, and as one of the tools, look at the ADX. The ADX should show that the trend is easing. That means the ADX slope increases by 0.25 or less, and better would be a flat or negative ADX slope. So here we have a bearish engulfing pattern, and the slope declined by 1.8. Once again, we didn't have to look at the numbers because we could see the slope on the chart, right? For bull candle signals, and I'm going to go through this in a minute, we get the candle signal. ADX slope increases by less than 0.25 and better if the slope is negative. We don't have to worry too much about the trend. If the slope is flat, what kind of trend do we have? No trend. So although we're saying and this should be, again, shows the ADX, it should be uptrend easing. If it's less than 0.25, the uptrend is easing, but if it's 0, there's really no uptrend anymore, right? And this one, for the bull candle signals, okay, shows if the downtrend is easing, again, if it's 0, there's really no trend to worry about. And let me go through these numbers here. Okay, so ADX on session 1. First of all, what is that red semicircle? Anybody recognize the pattern? The 3 candlestick pattern? Morningstar, right? All right. So, candlestick line 1 is 31.97. Candlestick line 2, the slope is up 0.7, right? Candle line 3, the slope is what? Down. Okay? So that's showing us that market is now trendless. And with number 4 here, it's still trendless. And essentially, the Morningstar was confirmed on the third candle with the ADX. And the Morningstar, like a lot of the other patterns, can be used as support or resistance. But I wanted to show you something interesting. Look at candle line number 6. What is the ADX on number 6? Slope. What's the slope? Down. Now, why is that? Didn't the market rally? It's a lagging indicator for new trends. So again, that's a downside. Once again, we're all going to have different resistance areas. But where would you be buying if you were buying here?
4, probably. Obviously, we see what 5 is. 5 would have been the best day, but you don't know that yet.
All right. I'll tell you personally
Or
what I would
5.
suggest. And I'm glad nobody said 3, because that short, you see the little upper shadows at area 1? That to me would be a short-term resistance area. Now, 4, we held the support. Did we hold the support? Did the market hold the support? But get real here. Where did the market close? Right on the low. Is it a long white or long black candle in 4? A long black candle. And if you're buying, you're pretty gutsy, because it is holding support. But I would be nervous about a market closing at support. So again, if you're a little bit more risk-oriented, you may think about nibbling. The real answer, and I know most of you said that, to me would be 5. Because it's now confirming a support area, almost a hot on me pattern. I don't know if it's 25% or less, but nonetheless, it is confirming the support area. So the correct answer to this would be number 5. So let's go over what we learned with the ADX. The ADX shows the force of the trend. We went over the pluses and the minuses of the ADX as a lagging indicator, especially when it's starting new trends, but we're not concerned about that. We're using the ADX to show a diminishing of the prior trend. ADX, we've looked at ADX and reversal candles. The slope and not the level of the ADX is the critical factor. And ADX is not the only criteria. It's just one of the tools for the trade. Now, as I mentioned before, I could talk days about the ADX. There's ADX for V tops and V bottoms. You use ADX differently for momentum candles, like rising and falling 3 methods, rising windows, falling windows. You could actually use ADX components of it, the average true the ATRs, to get price targets. You could use, there's one way you can use the ADX to actually exit, but I could spend a whole day on the ADX. So, but what we looked at today is using the candle reversal signals and the ADX. So as a general rule, as the trend is weakening, we can think about the reversal signals. So we have a question here?
Can you do that last slide just one more time?
Sure.
Just run through it.
Okay.
Because right at number 5, when the slope goes down, can you kind of explain that a little bit more?
Okay, so number 5, the slope is going down. And I guess what's the question?
Just run through it one more time.
Okay, just very quickly. The Morningstar pattern is at 3, and at 3 we did get a negative slope, so that's showing us the trend is this market is pretty much trendless, and that's what we want because we're not going against a strong trend with the Morningstar. Then the next question was, would I be buying? Where would you be buying after candle line 3? And the answer was, if we buy at 3, it's probably a poor risk reward. And I always have the caveat, my resistance may be very different than your resistance, but I would have a minor resistance area over here. So if you're buying at 3, it's not a good risk reward. And then I had mentioned, and some of you had said 4 might be a buying opportunity because indeed the lows were holding of the Morningstar, but you're buying on a very weak session. The next day the market bounced back a little bit, confirmed the support area again, and the correct answer, I think, would be buying on candle line 5. Because you have a better risk reward, it's confirmed the support area, you didn't close as a long black candle. We're now going to segue into measured moves. We're looking at advanced technicals. And the reason we want to look at measured moves is because, as we had mentioned in the introduction, candles don't predict where prices go. So I had this cartoon made up. It says, I can tell you how far it is, but I do not. But I can't tell you how far it is, but I do know it's that way. Okay? So with the candles, we get the reversal signals. We're telling potentially where the market could be heading. It just doesn't tell you how far it's going to go, and that's why we need Western technicals. So lots of ways to get price targets. You'll get prior highs and prior lows, Fibonacci retracements, moving averages, and so forth. One way is using measured moves. So here, for example, a basic way, even before we look at measured moves, here we have a gravestone doji at a resistance level. This is a potentially nice trade. Where would a target potentially be? To me, it looks like a box range, right? Remember previously I said I love trading box ranges because now you have clean-cut support and resistance areas. You also have potential targets. So, box range. Okay, why Western technicals? Because Western technicals are price targets and for confirmation. This is a nice chart to show that. We have a bull channel here. We can extend the bull channel. And what do we have at the top of the bull channel? Right, we have the resistance, a bearish engulfing pattern, right? And where's the potential target? Bearish engulfing pattern is confirming a resistance area. And where's the potential target? Bottom end of the channel. Right, just the bottom end of the channel. We don't know what's going to break under there or not. Swing target. Okay, this is a way to get a potential measured move. You take the height of the rally, and the market digests the gains, and you take the height of that rally, and whichever the correction low is, you take that height and add it to get a target. This is similar to, many of you are familiar with bull flags or bear flags, same idea. So here, it says east and western top. We have a rally. The market digested the gains and then broke out. Once the market breaks above resistance, what should be new support? What should be new support if you break above a resistance area? Old resistance, yeah. But we're looking at targets here. So you take the height of the range as a potential target. And you go, now, in classic, if you look at Western technical analysis books, I do things a little differently because I'd rather get out earlier on a potential trade. And actually this red line should be a little lower here. It should be at the bottom of the green box. So over here, some books will have you take the measured move, you go from the high of the breakout, you go from the high of the box range. I'm a little bit more conservative. I find it works a little better. I go to the low of the box range. That's how I get a target. Question, Paul?
Would you consider that as a bull flag and then take the distance from the bottom of the pole all the way up as a
measurement? That's what
Could
we
you
kind
do
of
that?
do. Yeah, it's the same. The question is could it be viewed as bull flag? A classic bull flag actually is the market moves up and then it moves down. Right, but this is the same concept. Either way, what's happening is by trading either laterally or the market moving down, it's relieving its overextended condition. So, and then you take the height over here. And normally, just because you get a target doesn't mean you get out of a trade, or certainly would not be a reason to initiate a new trade. But if you get a candlestick signal confirming the target, I would exit a trade. Again, just because there's a target, even if you get a bearish, in this case, a bearish candlestick signal, I wouldn't go short. I would only use that target and a bearish candlestick signal to initiate new trades because it's not confirming a resistance area. It's a potential target, and other traders may not be looking at the target the same way you are. What I like about resistance, especially obvious horizontal support and resistance, everybody's looking at the same levels, right? So I would use this to exit a long position. Here on the downside, the US and the Canadian. Flip side, here we looked at a swing target from the upside before. Now we're looking at it from the downside. So the US in the green or the red semicircle. On the left, bearish engulfing pattern. This was the highs in the dollar a while ago. Market pulled back, digested the gains over here. I'm sorry, digested the sell-off. Okay, and this line actually should be kind of like this here. And so once the market, similar to a bear flag, once the market broke under here, you take the height of the correction here, and then you subtract it and you get a target. This happens to be a weekly chart. I was following weekly on this. And what do we have at the target? Hammer, right. So again, really not enough of a reason to go long, but certainly if you're short, to take some profits on that. So this is a swing target. Okay. Head and shoulders, I'll go through this quickly, just in case you don't remember the head and shoulders. The market rallies, pulls back, then rallies again. The center rally is higher than the first rally, pulls back again. The next rally, the third rally, is lower than this second rally. So you have three rallies. The middle rally, it's called the head and shoulders because it looks like a person's head and shoulders. You connect the low of what's called the head, and you have the neckline, and the market breaks under the neckline. It's a sell signal. And what's nice about the head and shoulders is you use change of polarity, because old support should become new resistance. So this is head and shoulders top. And some of you may be familiar with, and I've made reference to this before, the three Buddha pattern. Okay, in Japan, their head and shoulders is called a three Buddha pattern because in the Buddhist temples, they have a large central Buddha, like the main Buddha, the main Hancho, and then they have like two smaller Buddhas, two smaller saints, and we in the West call that McDonald's. I have no idea why I made that in yellow, but after I did this, I realized it looks like the McDonald's thing. But the story I mention is, in my research, the Japanese had this back in the 1700s. And we had this in the 1920s. And it's not that we copied the Japanese. The technicals mirror the emotions of the market. And whether it's in the East or the West, it doesn't matter. You know, a chart is a chart no matter where it's drawn. And I was giving a seminar on Europe years ago, and I thought about it, and I said, here I am, an American, teaching a European about Japanese trading techniques. It's like math. You can write a mathematical symbol anywhere. It's universal. Same thing with the chart. So it's just interesting that the Japanese have the same pattern. But let me show you this, the idea of the head and shoulders, and more than that, just ways of using measured moves and candles. Okay, so here, and I'll tell you why we have the title that says why we're here. So in the S&P, head and shoulders, now obviously the neckline doesn't have to be horizontal. We have a head and shoulders here, and we have the left shoulder, head, and right shoulder. The market, well, for a measured move, first of all, you take the height of the, you go to the high of the head here, to the neckline. Wherever the market broke down, you take that distance to the neckline. That becomes a minimum, supposedly a minimum target. And look how nicely it worked out as a resistance area, neckline. So, now, why we're here, in that red ellipse, we got a series of reversal signals with those candles. And I'm going to show you what they were in a couple of minutes. But essentially, when we're using Western technicals, which are great for measuring targets or for confirmation, but you're going to find, and that's why you're here, the candles are going to be very often the first to give you turning signals, tentative turning signals. So the turning signal we got with the head and shoulders, obviously you have to wait for a close under the neckline. Be really careful about trying to anticipate a head and shoulders top. I see it time and time again that, say the market is over here, and people are calling it a head and shoulders top. When is it a head and shoulders top? When it breaks the neckline. Okay. One of the trader I know, an old, it's been around for ages, and he said that there's very few things more bullish than a failed head and shoulders top. Okay, so think about that. In other words, it's not a head and shoulders until it breaks the neckline. If it doesn't break the neckline, very often, from his experience in the equity market, it's bullish. But even beside that, it's not a head and shoulders until the neckline is broken. So the neckline was broken on this black candle session here. If I want to give a level here, it's about 13. Wait, even intraday, but if you want to wait for the close, around 13,250. We got in the red ellipse area, I'm going to highlight it now, these were the reversal signals we got at the high before the head, the high of the head, actually, of the head and shoulders. So let me go here. So 1, bear hat on me, right? 2 is the dark cloud cover, and 3 is a bearish engulfing pattern. I checked it on my recognition. The trend was up enough for it to be a bearish engulfing pattern. So, but even if you didn't view 3 as a bearish engulfing pattern, you had 1 as a Hadarami, 2 as a dark cloud cover, which became resistance. The little support area, once the market broke under, becomes no resistance. So essentially, we got potential reversal signal. Let's say the close under this red horizontal line at around 14,000, hundreds of points before we got the reversal signal with the head and shoulders. But the head and shoulders becomes useful to get a potential target. Okay, this was, I mentioned before, I don't do articles because it just takes too much time. So for magazines, I'll say if you want to interview me, fine. So this was an interview I did in Technical Analysis of Stocks and Commodities. And this was, although the magazine came out in March of 2003, I mean, this is all in print. You can go back and check, my comments here. The actual interview took place on January 24th of 2003. And at the end of the interview, the interviewer asked, what do I think about the S&P? And my final comments during the interview were the head and shoulders top on the S&P gives a target to near 775. A close over 870 would void this. Let me go through this. The head and shoulders top actually gave a target a little closer to around 780, 785. The reason I did 775, and you can't see it here, you can see part of it, but the major lows in 2002 on the S&P, and you can check the weekly charts, and this was made with a hammer, and this over here, you see part of this white candle and part of this black candle. It was actually a bullish engulfing pattern. So those lows were 775. That's where I got the number from, but I'll show you. The actual target was a little different. I just nudged a little bit. It was a pure coincidence. It worked out really well. The day of the interview was the day the neckline of the head and shoulders broke. Okay. So we swing into Western technicals. We have a neckline. That was the interview. Once the neckline is broken, it should become resistance. Whenever we place a trade, we're going to look at stops later, there's always a price that says we're wrong. Where did I get 870 from? A close over 870 would void this target. Where did I get that from? The neckline, right? If the head and shoulders, you break under the head and shoulders, what should become resistance? The neckline. The market got to 869. My target was, again, I really massaged it a little bit. It was 775, but let me show you what the real target was. See what I did? I go from the high of the head to the neckline on the session of the market breakdown. So that was the actual target around 782. Right? And what did we get at 782? It's a little hard to see, but I'll hammer. Those were the major lows in the S&P in 2003. And again, this is all in print. You can look at the article. These are the last comments I said. This is a way, and we'll get to your question in a second, this is a nice way of looking at Western technicals and candles and money management. The candles confirmed a measured move based on the head and shoulders. You would have a head and shoulders in the bar chart. Is there any reason not to have it on a candlestick chart? No. Whatever you do on a bar chart, you do on a candlestick chart. So now we have a hammer confirming a measured move. There's a price that says we're wrong. Close over 870 would void this. So there's a question, I believe? No? Okay.
A slide or two back, where we were looking at old support becomes new resistance, which gave us a much earlier entry than the Western technicals. Yeah, can we go back to that?
Mm-hmm.
Yeah, right there?
Okay.
Okay.
Yeah.
So could you take us through your thinking in this trade? And my question is if we entered based on the candle and not the head and shoulder pattern, which had not yet completed,
right?
What would be your thinking as you enter the trade at this point, maybe at number 3?
Okay.
And what would be your thinking in terms of risk and reward, and at what point would you change your view to be a head and shoulders pattern?
Okay, I'll answer the last part first. When would you change the view to be head and shoulders pattern? You don't know it's a head and shoulders until the pattern is completed, right? Okay, as far as over here, what I'd be looking at, you had mentioned thinking about doing something on the short side at 3. I wouldn't do that because it's at a support level. Okay, right, it's at a support level. But I would be seeing, especially with the close under that red line over here, okay, over here, my first potential support area would be down here, but I would be concerned, especially with this, with the failure here, that the market is topping out. So I don't think I'd be selling short here, but I would certainly be lightening up along positions here, and with this change of polarity, especially like over here when it's pulling back, because my target would be this hammer, this would be a good risk-reward trade over here. Okay. Oh, is there another question? Okay, so let me move on here. Okay, now we're going to be looking at my favorite measuring tactic. And I've made reference to this before, and we're going to look at box ranges. Now, previously, I've discussed using box ranges to trade, and I still like that. The market's at the top end of a box range. You get a bearish candlestick signal. You think about selling it with the target to the bottom end of a box range. Market's at the bottom end of a box range, and we get a bullish candlestick signal. Think about buying it with the target to the top end of the box range, assuming it's a good risk-reward trade. Now let's look at breakouts. So here, the market is breaking out, and whichever way it breaks out, and the analogy I used before is like a coiled spring. Whichever way it breaks out, the market should, as a target, move the amount that it had within the box range. Okay? So, here the market broke down. Under the bottom end of the box range, we take the height of the box range and subtract it from the breakdown point. Opposite, market breaks out of a box range, and we take that distance and add it to the breakout point. And what's good about a box range is we can then use change of polarity also. We have the bull sash pattern shown here. The market got, and it's a little hard to see, but let me draw it here because okay, we have actually a reason over here. So I have a resistance area over here, and this is a support level over here. Okay, so a box range. So the market got to the top end of the box range over there. A hat on me. I don't know if it's, again, 25% or less, but it's pretty close. The market pulled back. Over here, what did we have? Another bull sash, right? The market then got above the resistance area. Okay? So now we have a potential target. And let me redraw this again. Okay. We now have a potential target. And you don't even have to wait for a close. If you're a little aggressive, as soon as it moves above here, you think about buying it. This is a minimum target. Okay. So this is just a sample of a box range breakout. Okay. And okay, here a box range breakout again on the downside. And this is a nice example of old support becoming new resistance. And we have a minimum target. Okay, that's the break, the close under the support level. Okay, the last one was a 4X. This is a 4X. Once again, doesn't matter if you're trading futures or stocks, concept is the same. And here we have on the left, it's a little hard to see probably in the back of the room, but this is a bullish engulfing pattern over here, right? And I don't know if I drew it on. No, I didn't. Okay, let me go back here. There's a bullish engulfing pattern over here. Became support. Okay, another bullish engulfing pattern here. Okay, this is a, we're going to look at this a little bit later, a bearish engulfing pattern. The market broke out. Nice box range. Take the height of the range, add it to the breakout point. When there's a resistance zone like this, I kind of put it in the middle. Okay. Don't worry about being too exact on this. And we get a target, and anybody see what we got near the target? Okay, within a couple of days, a bearish engulfing pattern, yeah. And again, I would suggest taking off longs. I don't think a measured target and a bearish candle signal is enough to initiate a new trade. And look what held as support back in August, the bullish engulfing pattern. Okay, and let me show you where August is, because the charts may not be that sharp back here. the bullish engulfing pattern. Let me extend it here. Okay, the question is, with the popularity of candlestick charts, is it kind of self-fulfilling? So in other words, we have the swing target, and then we have the engulfing pattern. People see the swing target and the engulfing pattern, they all act on it. And I don't think so, because most traders are using, there's so many technical indicators out there that, not many people are going to be looking at box range breakouts as a potential target. And while a lot of people are using candles, almost all of them are using them incorrectly. I can tell you that from the emails I get, from the articles I read by other authors, the books, they're almost all wrong. So it's to your credit that you're going to learn how to use them correctly. So, they'll be buying what they think is a bullish engulfing pattern, a white wrapping around a black during a rally. We know it's not a bullish engulfing pattern. So, no, I'm not worried that it's going to be, self-defeating, or however we want to phrase it. The question is, I wouldn't short there because there's nothing else confirming it. If you're a little bit more risk-oriented, remember the idea we had, if you have a candle signal confirming a Western signal, and then, we looked at ADX also, but let's just look at candles in a resistance area. This wasn't at a resistance area, but if you're a little bit more aggressive, you see this, you think to yourself, okay, you may sell short lightly, just keep a stop above the high of the bearish engulfing pattern. So. Yes? Question? Right, a box range, and that's a good question. How do I define a box range? You have to have a support level tested more than once, and you have to have a resistance level tested more than once. If you only have one support and one resistance, it's not a box range. So here we had support area tested multiple times, and the resistance area tested multiple times. Support, 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 resistance, resistance, okay? Resistance over here, right? And I'm glad you brought that up, because at box range it has to be tested a few times. Okay, here in crude, box range breakout. The market, and we saw this previously in one of our other sessions when we were talking about momentum trading. Remember, we said if we get above the high of the bearish engulfing pattern, it could be a bullish signal to go long. But actually, we had a box range. We take the height of the range, and we get a target, and we have a dark cloud cover there.